Today on Crypto Channel Direct, Goldman Sachs sees Fed rates hikes impacting Bitcoin's price and NFTs are falling prey to the darker side of crypto, while Meta abandons its troubled Diem cryptocurrency venture. I'm Claire Ross-Brown and welcome to CCD, where I'll be bringing you the news you need to know, powered by Concordium. In an investment research report, Goldman Sachs warned that Bitcoin is increasingly vulnerable to Federal Reserve's potential rate hikes as the cryptocurrency grows more widely adopted. Goldman Sachs explained that as mainstream adoption of Bitcoin increases, so does the cryptocurrency's vulnerability to Fed policy. Over the last 2 years, as Bitcoin has seen wider mainstream adoption, its correlation with macro assets has picked up, the report read. Assessing that higher bond yields may have affected technology stocks in recent weeks, the analyst noted and added Bitcoin and other digital assets have likely suffered from the same forces. These assets will not be immune to macroeconomics forces, including central bank monetary tightening. However, these findings seem to be both counterintuitive and in direct contrast to the current market activity. After recording heavy outflows at the start of 2022, cryptocurrency investment funds have seen a gradual uptick in investor demand over the past 2 weeks. According to CoinShares, digital asset investment products saw $19 million worth of cumulative inflows last week. Bitcoin helped to lead the gains with $22 million worth of inflows. Despite the improvement in the second half of January, digital assets witnessed heavy outflows since December as institutional investors took profits and reduced their positions amid extreme sell-offs. Bitcoin funds realized $131.8 million worth of outflows and $111.2 million worth of drawdowns during January. With this renewed institutional energy, popular Bitcoin bull and MicroStrategy CEO Michael Saylor announced he's even hosting an institutional-specific Bitcoin event this week. And in a tweet on Sunday, Saylor said the event would be for corporations interested in integrating Bitcoin into products, services, or balance sheets. So has Bitcoin really become an institutional investor asset? And should we be aware of general market trends when thinking about investing in the so-called digital gold that is Bitcoin? Let us know your thoughts in the comments. NFT trading continues to skyrocket, with the latest figures suggesting volume in January exceeded December by 129%, but not without major controversy. Much of the January increase was attributed to a new NFT marketplace, LooksRare, which accumulated nearly $2 billion in volume after its launch on January the 10th, though it seems much of this newcomer's volume was due to wash trading. In a tweet, CryptoSlam, a popular NFT listing exchange, noted that they removed $8 billion from wash sales from their January monthly industry sales figures. Wash trading is a series of trading activities involving the same trader buying and selling the same instrument simultaneously, creating artificially high trading volume and a manipulated market price for the asset in play. Neither wash trading nor irregular bidding seem to follow the profit-sharing motto of the NFT community, as the data suggests a large portion of the rewards appear to go to only a small number of investors. Delphi Digital points out that this current model is unsustainable in the long term, and trading volumes likely to drop significantly as traders leave when it's no longer profitable for them. While real problems such as subjective art speculation pricing, regulatory concerns, and governance issues remain areas to focus on long term, the proving of an online ownership is a benefit of the NFTs that something may outweigh the risks. Some tools such as Twitter Blue and DAO governance structures, still new and yet to be proven, may help to govern this new and emerging space. But what are your thoughts on fully regulated NFT space so that we don't wind up just creating the crypto Wild West rebooted with this NFT movement? Tell us what you think in the comments below. NFTs have arguably become the most popular use case of blockchain technology in the mainstream, and their adoption is massive. However, as a sector of this emerging technology, they're still feeling the sting of the more unregulated side of blockchain and crypto. We've seen wash trading on LooksRare, as well as hacks and phishing schemes on OpenSea, and this has even caused controversies about the decentralized nature of these marketplaces. But there are darker concerns about money laundering and other illicit uses for NFTs. But do you think that we should be worried? Now we're going to turn to Philip Mostert from SpaceSeven, an NFT marketplace, to ask him about the Wild West of NFTs. Philip, welcome.
Hi, Claire. Thanks you for having me.
Very good to have you here. Philip, I wanted to ask you, NFTs are in many respects less regulated than Bitcoin, and yet we have a lot of people snapping them up and entering the space. Do you think that we're in for some trouble here if the darker side of crypto starts impacting people?
Yeah, I think it's a wonderful question. I think it comes with any emerging industry. I would compare it to the dot-com boom in the early the 2000s, where there's a lot of money to be made. So obviously, a lot of people are going to be very interested in the space. With that is obviously it's going to attract the illicit characters, the unscrupulous trades or fraud that is inherently with a lot of money to be made in the space. I think it's just about maturity, and I think we're still so early in the, in terms of what NFTs are and where it could be headed in the near future.
Yeah. And Philip, thank you for that. Well, what in your opinion needs to be done to make sure that the NFTs are safe and secure and welcoming of all without fears of hacks, thefts and money laundering?
Yeah, it's obviously first and foremost, NFTs and blockchain crypto largely has to be regulated at some point, or at least embrace regulation. It's one of the philosophies that we have, and it's the reason why we've chosen to build on the Concordium blockchain is because we do believe that space will be regulated, and we need to identify technology partners or providers that share this ethos, or in terms of an ethical compass, if you will. We believe that a lot of it will be mandated to be in terms of transparency and also ID required, or KYC at protocol level, which is one of the mandates of our ecosystem.
Yeah, and have you got any more insight about how regulators are trying to make the NFT space more secure and less susceptible to some of the issues that plague crypto?
Yeah, there's a lot of hype around the activity. You're going to start to see a lot more, titles or news being broadcast about the type of trade volumes that some of these platforms are doing. I think we're looking at the wrong metrics currently. It's like the old e-commerce days where people were referring to GMV or gross merchant value. It's the wrong metric to look at in terms of the authenticity of what constitutes that trade to be. I think it's really going to come down to a lot of more transparency and a lot more accountability from both the platforms themselves to regulate the transaction and the trade, and a lot more sort of embracing with regulation in terms of the potential to be audited.
Brilliant. Thank you so much, Philip, for joining us today. Really great speaking with you.
Thank you very much, Claire.
Diem, the stablecoin project proposed by Facebook, looks to be dead in the water after it was announced that the assets of the venture had been sold off. Meta, formerly Facebook, made big waves in the crypto space when it announced the creation of Libra, a cryptocurrency which soon ran into a number of regulatory hurdles. Now, Libra was rebranded as Diem, and now the Diem Association, which runs the project, announced the sale of assets of the cryptocurrency venture to Silvergate Capital Corporation for $182 million. It appears as if regulation of the cryptocurrency was at the heart of the sale, as the association said it became clear from dialogue with federal regulators that the project could not move ahead. Diem Chief Executive Stuart Levy wrote, "As a result, the best path forward was to sell the Diem Group's assets, as we have done today, to Silvergate. Over the coming weeks, the Diem Association and its subsidiaries expect to begin the process of winding down. At the heart of the regulatory concerns were the entrusting of a firm like Facebook with a cryptocurrency. Libra was bought before the Senate, and concerns about privacy scandals from the social media giant were brought up. The company has shown through scandal after scandal that it doesn't deserve our trust," said Senator Sherrod Brown in a Senate hearing in 2019. Facebook's former crypto head and Diem's co-creator David Marcus said on Twitter, "The idea might fare better with a more acceptable promoter." The Financial Times wrote that the regulatory hostility put a stop to the Diem experiment. Facebook's size, the newspaper argued, meant that Diem was a challenge to the status quo, and it was surprising the firm had not foreseen the problems ahead. Do you think that Meta should have stuck with creating its own crypto, given the direction the firm is going, or was Diem doomed to begin with because of strict regulations? Let us know in the comments below. And if you're enjoying today's show, like and subscribe and join the discussions in the comments below. Banking and institutional investment have often been at odds with Bitcoin, especially in the early days of the digital asset's rise to prominence. We saw the likes of JP Morgan's Jamie Dimon call Bitcoin a fraud, but a few years down the line, the major bank is making its own cryptocurrency and embracing others for its clients. Now, in 2022, we want to know what institutional investing and banking is making of cryptocurrencies and how they're either embracing or excluding this new digital financing space, especially in light of the growing DeFi sector. We have with us today Lars Seier Christensen, the former CEO of Saxo Bank, owner of Seier Capital and founder of the Layer 1 blockchain Concordium, to discuss the attitude change in traditional investment when it comes to blockchain and crypto. Hi Lars, and thank you for joining us.
Thank you for having me, Claire.
Lars, can you tell us a little bit about how you've seen crypto and blockchain rise to prominence in the traditional investing space? And also, can you also share sort of what is the sentiment around this emerging space and how it's changed in the past 5 or so years?
I think it's changed a lot from being, completely outlandish to many in the traditional legacy world of finance to now being a subject of interest. You're having conversations today that you wouldn't have had 3-4 years ago, or maybe even 2 years ago. And that's because, of course, that people are seeing not just some of the cryptocurrencies as investment objects, but also because there's an increasing understanding that the blockchain itself, this technology, could have a transformative potential that is quite significant in terms of creating new business models and enhancing a lot of existing processes and business models.
So what would you say has been the driving force in investors and bankers taking crypto seriously?
I think it's one that some of the technology-oriented people in the sector can see that blockchain and DeFi has a potential to make a lot of investment processes more optimal, with more finality, etc. But also simply the fact that there's a customer-driven demand for some of the crypto assets, i.e. when your clients start asking, can you serve me in Bitcoin, can you help me buy Ethereum, can you help me invest in the space? You got to respond, right? Because otherwise they're going to take their business elsewhere. So I would say it's probably more driven by a number of family offices, a number of high net worth individuals that are asking for services in these areas rather than a burning desire to go into them per se. And that's always is the way it is with banking. What clients demand is what you have to look at and what you have to try to deliver to them.
So if we consider then that Bitcoin is well adopted in traditional investment and blockchain projects on the rise, what do you see as the next big trend? Is it DeFi, or do you think that there's something else investors are looking out for?
I would give a little pushback. I don't think that Bitcoin is generally broadly accepted in the finance industry, in the traditional finance industry. I think there's a growing interest. A few people are dabbling in it, but when you're talking about institutional interest in Bitcoin, I think we have to be realistic and say that's largely crypto institutions and not classical institutions. And the reasons for that are many. There's very unclear regulatory space around it. There are a number of issues associated with the early generations, particularly anonymity, which is unacceptable to financial institutions and most serious corporates, actually. So it's not yet fully accepted, but the interest is there. People see it as an interesting potential asset to deliver services in. I mean, a bank wants to make money. A bank needs to deliver the products to their clients that they can actually sell to them and hence get a revenue stream from. And that's driving it. But there are also major concerns about going into the really exciting part of the DeFi and blockchain space, because the regulation is still very unclear and a number of the actors in that space don't take it too seriously anyway. And that's just not acceptable for a serious institution or a serious investor, because they have a lot of obligations vis-a-vis their regulators and, of course, their investors.
Great. Well, thank you so much, Lars, for sharing your insights.
Thank you.
NFTs have become commonplace in our everyday life, but not everyone truly understands them or why they've become so popular and such big business. Let's learn with CCD. NFT stands for non-fungible token, and non-fungible in this case means that the token is unique and cannot be traded or exchanged at equivalency. This differs from Bitcoin or even the US dollar, where one Bitcoin or $1 always represents the same thing regardless of which coin or node you hold. Blockchain technology has become a perfect proving ground for NFTs, as the technology offers immutability and allows tokens to be unique and irreplaceable. It also allows for the token to represent digital assets such as artwork, collectibles, and other rarities. The notion of having a unique token representing something like artwork has seen many people flock to the NFT scene. And in the fact that the NFTs also contain ownership details for easy identification and transfer between token holders means a whole new marketplace has been created. Today, we see some of the world's biggest artists either buying NFTs or making their own. Similarly, the likes of Tom Brady and other superstars have launched NFT marketplaces and other tools to further the space. Some may feel that NFTs are a bit of a fad, but their possibilities and potential are broad. The idea of unique digital representations and tokenized physical assets is not novel, nor is the use of unique identification. However, when these concepts are combined with the benefits of a tamper-resistant blockchain of smart contracts, then they become a potent force for change. Thank you for joining us on Crypto Channel Direct, powered by Concordium, and don't forget to like and subscribe by hitting the button below. We'll be back next week with the news you need to know, and until then, I'm Claire Ross Brown. See you next time.